Please note, the following video and all data presented are strictly for educational purposes. They do not constitute financial advisory or investment recommendations. Always consult a SEBI-registered advisor before making trading decisions. The Indian equity markets are currently exhibiting severe intraday whiplash. In a single recent trading session, the Nifty 50 opened with a massive gap up, dropped 365 points toward the 22,600 level, and then reversed course to close at 22,900. That is a 500-point swing from the day's high to the day's low. This chart maps the Nifty 50's intraday price action against the spot price of Brent crude oil. The relationship is currently inverse. Early in the session, as Brent crude reached $100 per barrel, the Nifty traded in the 22,700 range. The moment crude fell toward $95, the index recovered toward the 23,000 mark. Algorithmic trading desks and retail participants are reacting aggressively to minute-by-minute geopolitical rumors out of the Middle East. At the same time, they are looking past quantifiable alarms flashing across domestic economic indicators. These 500-point intraday recoveries remain tethered to the $5 volatility of Brent crude. The market is currently pricing in a geopolitical resolution, even as underlying economic data continues to deteriorate. The algorithm-driven buy orders were triggered by a highly specific catalyst: Donald Trump's assertion that his team was negotiating a 15-point peace plan, which included a proposed 5-day pause on infrastructure attacks. This claim was met with immediate contradiction. Iranian leadership flatly denied that negotiations had taken place and launched a new barrage of missiles toward Israel before the Indian markets even opened. Despite these conflicting reports, market participants are looking for any signal of a bottom. The mere mention of a potential ceasefire serves as an immediate buy signal for systems programmed to trade on headlines. These temporary drops in crude prices and the resulting retail buying surges are providing cover. Foreign institutions are using this liquidity to distribute their holdings ahead of a projected macroeconomic contraction for the 2026 fiscal year. Navigating this environment requires separating geopolitical noise from the hard macro data and tracking the institutional order flow. This map illustrates the Middle Eastern maritime routes, specifically highlighting the Strait of Hormuz. For the Indian market, this narrow waterway serves as the logistical choke point dictating the physical delivery of energy supplies. The Nifty is currently acting as a proxy for the vulnerability of this specific trade route. When perceived risk pushes crude to $100, the index drops to its 22,700 floor. When tensions ease and crude falls to $95, the market rallies back toward 23,000. For the moment, physical logistics remain intact. Indian shipping continues to pass through successfully, with vessels like the Jag Vasant and Pine Gas safely transporting over 232,000 metric tons of LPG into domestic ports. Reliance Industries has capitalized on the regional instability, utilizing a temporary suspension of sanctions to acquire 5 million barrels of Iranian oil. Yet the regional instability continues to expand. Israel has officially declared its intent to take and hold the region extending up to the Litani River in southern Lebanon. This expansion ensures that the baseline risk premium remains elevated for all emerging market equities. A risk premium is the extra return investors demand to compensate them for higher uncertainty in volatile regions. As long as physical logistics flow, the market will ignore the physical war. However, an actual disruption in the Strait of Hormuz would likely shatter the current technical floor. While retail traders focus on geopolitical headlines, they are looking past a significant deterioration in domestic macroeconomic data. This table details Goldman Sachs' latest projections for the Indian economy. Prior to the escalation, they projected a 7% growth rate for calendar year 2026. They have now cut that forecast to 5.9%. We are already seeing the effects of inflation hit the ground. Rising wholesale price index metrics are triggering an automatic 3 to 5% rate hike across all national highway tolls starting April 1st.
The immediate threat of high interest rates has triggered selling in interest-sensitive sectors. IT and banking heavyweights showed a negative cash-to-futures arbitrage of over 1.5%. Arbitrage here means the futures contracts are trading lower than their immediate cash price, signaling bearish sentiment. The market's current index valuations remain misaligned with the incoming reality of high inflation, higher borrowing costs, and lower economic growth for FY26. To understand how the index sustains 500-point intraday recoveries, we must analyze the order flow to see which participants are providing the volume. In the cash market, foreign institutional investors, or FAIs, have been net sellers for 18 consecutive sessions, dumping around 8,000 crores of equity in a single day. Domestic institutional investors, or DIIs, net bought roughly 5,000 crores, attempting to stabilize the market by purchasing at current levels. This chart tracks derivative open interest, the total number of outstanding futures and options contracts. Retail clients currently hold a net positive position of 26%, while foreign institutional investors have shifted to a net negative position of 20.5%. Proprietary trading desks are also positioned heavily on the negative side, aligning with the foreign institutions. This dynamic creates exit liquidity. Hyper-bullish retail clients, buying into every brief geopolitical headline, are providing the volume buffer needed for institutional participants to offload their positions without a sudden collapse in the spot price. Institutional participants are utilizing high retail optimism to exit their positions, distributing significant risk onto the domestic market. Moving away from the broader indices, we can track microcatalysts to see exactly where domestic capital is hunting for safety and yield. HDFC Bank saw its share price rise by nearly 3% following the appointment of an external firm to review a chairman's resignation. Capital is rewarding institutional safety and strict governance over broader market growth. We also see capital fleeing into alternative assets. The Rajasthan Royals IPL franchise was recently valued at $1.63 billion, indicating that cash reserves are chasing private equity as public equity uncertainty increases. While corporate capital exhibits pockets of excess, state-level economic engines are under fiscal stress. Karnataka is currently diverting funds away from infrastructure development to fund guarantee schemes and disaster relief in regions like Wayanad. The broader logistical and state-level economic engines are slowing as capital aggregates in isolated high-governance assets. This is a daily candlestick chart for the Nifty 50. When we map the macro data onto the price action, the technical trend is clear. Notice these formations with small bodies, known as dojis and spinning tops. These candles occur when a session's open and close prices are nearly identical, despite movement during the day. The long upper and lower shadows you see here are technical indicators of absolute market indecision. The 50, 100, and 200-day lines are all sloping downward. Specifically, the 100-day moving average is on the verge of crossing below the 200-day average, a technical signal often associated with a long-term shift in price momentum. Momentum has weakened significantly. The Relative Strength Index, an indicator measuring the speed of price changes, has climbed slightly to 34, but remains trapped below the critical bearish threshold of 40. Based on maximum options pain data, the actionable trading range for the Nifty is strictly defined. There is a support floor at 22,500 and a hard resistance ceiling locked at 23,500. The Bank Nifty shows the same pattern: indecision, downward trending moving averages, and a strict resistance cap at 53,000. Despite the volatility, the multi-month price trend remains capped under these descending moving averages. Navigating this environment requires focusing on specific fundamental triggers rather than intraday noise. Brent crude remains the primary indicator. No sustained equity rally can be confirmed until crude decisively breaks and holds below the $90 threshold. The macro ceiling is set by the Goldman Sachs GDP downgrade and the Reserve Bank of India's projected rate hikes, which act as a mathematical cap on domestic growth. Trade the geopolitical ranges with caution, but respect the underlying macro downside and the ongoing 18-day distribution of shares by foreign institutions. In a market where retail optimism provides the volume for institutional exits, the only clear signal is the distribution of risk. Fade the geopolitical noise. Respect the macro reality.